Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, the 3rd of September. The month kicked off on a negative note, both for stocks and bonds across the globe, while precious metals amass inflows and crude oil extends gains above a critical resistance level on rising geopolitical tensions. Now, attention will be shifting toward the US jobs data starting from today, but there is no guarantee whatsoever that weak numbers from the US this week and dovish Fed expectations as a potential result of these numbers will bring appetite back. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So September didn't start on a positive note for global equities nor the global bond markets. Market sentiment was less than cheery indeed as America returned from its long weekend. The sell-off in long maturity bonds in developed nations accelerated. The US 30-year bond yield flirted with the 5% psychological mark and is just below that level at the time I'm talking here this morning. The Japanese 30-year yield keeps pushing higher toward multi-decade high levels above the 3.20% level, while the UK's 30-year gilt yield spiked to a level last seen in 1998. The French 30-year yield, on the other hand, also spiked to 4.5% mark for the first time since 2009, while the 10-year spread between the German and French sovereign yields spiked past 80 basis points, again capturing the budget crisis in France, where the PM François Bayrout's plans to rein in on debt are being firmly rejected by the opposition parties that could lead to a government collapse next week. Now, this debasement, the sell-off that we see in long maturity bonds in developed nations is explained by multiple factors, including the worries of ballooning sovereign debt, the political difficulties to rein in, and I'm looking at you, friends, and structurally higher inflation levels that these developed economies are facing today following the COVID disruption and now obviously the trade war and the tariffs as such. Investors around the world demand higher return for holding the sovereign bonds of these countries that face higher structural inflation and potential difficulties to pay back their debt. And higher yields will obviously increase the borrowing costs for companies in these markets and weigh on their valuations, or at least should weigh on their valuations. So that's the financial logic behind the moves. As such, both equities, sovereign and corporate bonds this week kicked off the new week and the new month on a meager note. Technology heavy big cap indices in the US led the sell-off yesterday, with Roundhill's Magnificent 7 ETF losing more than 1% during yesterday's trading session. The S&P 500 fell 0.69%, while small cap stocks retreated 0.60% as the short end of the US yield curve also cracked under the pressure of the sell-off in the long maturity papers. The European equities, on the other hand, fell 1.5%. Fun enough, the CAC 40 in France lost just 0.70% yesterday versus the German DAX that was heavily hit by a 2.30% sell-off. Chinese and Indian markets this morning are coming under some selling pressure despite their willingness to cooperate. They actually struck a deal this week, remember, to bring more Russian gas to China, and that's something big, mind you, and the Japanese Nikkei is also testing a long-run positive trend line base to the downside. The only thing is that the Nasdaq futures are better bid this morning on news that Google doesn't need to sell its Chrome anymore, and that's something really helpful for investors around the world. But will that help improve the global risk appetite is yet to be seen, of course. So where does the capital go when global stock and bond markets see heavy exits, right? Well, they go to alternative assets. Gold investors, for example, are having a blast this week with the price of an ounce breaking record after record. Silver extends its advance past the $40 per ounce level, and that despite a stronger US dollar yesterday, as some investors simply return to the safety of the US dollar despite rising doubts about the greenback's ability to maintain a safe haven status in the longer run. Then Bitcoin sees demand below the $110,000 level, and oil, the barrel of US crude, actually broke above the critical $65 per barrel resistance yesterday on the back of waning peace prospects in Ukraine. In fact, Ukraine struck 2 oil refineries in Russia this week, pushing Moscow's crude processing runs to the lowest level since May 2022, reports Bloomberg News. As such, contributing to unexpected tightness in oil markets and hence also reducing the prospects of supply glut in oil markets for later this year. And indeed, if we look deeper into the pricing in oil markets, the WTI's prompt spread, which is the price difference between two future contracts, has been rising since the end of last month, confirming worries of tightness in oil markets. So that's a bullish signal for short-term oil traders, and hence that the positive breakout that we saw yesterday could eventually lead to a further rise in the near run. So if the 50-day moving average resistance is cleared, oil bulls will eye the 200-day moving average that stands near the $67.65 per barrel level. Then new factors should determine the next direction. The broadly softer dollar has been supportive of oil prices recently, as cheaper oil makes oil cheaper for buyers on international markets and supports global demand, while a tepid demand outlook due to the global trade war's negative implications should somehow limit the upside potential into the $70 per barrel psychological mark. Now, speaking of trade war and the negative implications, the US data continues to bear the brunt of Trump's trade war. The factory orders in the US shrank for the 6th consecutive month on higher import duties, while ISM manufacturing data that came in yesterday came in softer than expected by analysts, except for new orders. That was the only bright spot in that data. Now, contraction in employment figures didn't ease as much as expected. That's not really good news, but prices accelerated less than expected as well. That's kind of good news, keeping the Fed those hopeful that the current situation justifies some Fed cuts in the near future. So the probability of a September rate cut from the Fed jumped past the 90% level yesterday. Of course, the US jobs data this week will either cement or put that expectation in question, but the weakening jobs market trend these days in the US suggests that there is a higher chance of seeing a weak data this week that would then boost the dovish Fed expectations than the opposite. So if that's the case, if we see weak economic data from the US this week, could we see the sell-off slow down on softening Fed expectations, or ideally reverse? That's the question. And the answer is hard to tell really, because at the current levels, the sovereign bond yields have gone high enough to justify a rotation toward these lower risk bond investments that offer quite similar returns, if not higher, to their investors. In the case of the US, for example, the S&P 500's earnings yield is around 3.35% today, hardly covering the erosion of value due to inflation. While the US 2-year bond yields 3.65% this morning, that's kind of higher than the US earnings yield. So it goes against the basic rule of thumb of higher risk should provide higher return, and there should be a readjustment. In Europe, however, the earnings yield for the Stoxx 600 companies is almost double of what we see in the US due to relatively lower valuations of the Stoxx 600 companies. And also note that the real yield in European stocks is about 4% due to lower inflation in Europe. So even with slightly more hawkish European Central Bank expectations of late, rotating towards Stoxx 600 stocks is still something that makes sense for investors in terms of risk and return analysis. And speaking of inflation and the European Central Bank expectations, yesterday's CPI update came in slightly hotter than expected by analysts, as the core CPI in Europe remained steady near the 2.3% level instead of easing to 2.2% as expected. But the latter didn't really change the European Central Bank expectations much. Mind you, the euro-dollar is downbeat this morning due to a broadly stronger US dollar and the widening French-German yield spread. The single currency and the European stock complex will likely remain under the pressure of rising sovereign yields in Europe and also the French political shenanigans for the rest of the week, which could then lead to interesting dip buying opportunities in Europe when the dust settles. So, this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.